January 2026 did not feel like a fresh start for Mark. He was 41, living in Ohio, working a stable operations role at a regional logistics firm. On paper, everything looked fine. His income was higher than it had been 5 years earlier. His expenses were under control, yet something felt wrong. Every month required attention, adjustments, and restraint. One unexpected bill forced trade-offs. One slow quarter at work created stress. Freedom felt distant, even though effort was constant. Mark was not lazy, reckless, or uninformed. He followed most traditional advice. He worked full-time. He avoided unnecessary debt. He saved consistently. What changed by 2026 was not his discipline. It was the economy around him. The U.S. economy entering 2026 quietly rewired how financial progress actually happens. Wages rose unevenly. Housing costs stabilized in some regions, but stayed structurally high in others. Corporate employment became more efficient, not more secure. Asset prices stopped rewarding passive patience and began rewarding operational control. The old formulas stopped compounding the way people expected. Mark noticed something specific. Friends who earned similar salaries had very different outcomes. Some felt financially calm. Others felt squeezed. The difference was not income level. It was income structure. In 2026, financial freedom in the United States is no longer about how much you earn. It is about how much control you have over the way money moves through your life. Control over timing, control over pricing, control over optionality. Mark learned this through a small, almost boring shift. He stopped thinking in terms of saving percentages and started thinking in terms of cash behavior. The first thing that actually works now is building income that adjusts faster than expenses. In 2026, inflation is no longer dramatic, but it is persistent. The danger is not sudden price spikes. It is slow erosion. Fixed income with fixed raises cannot keep pace psychologically or mathematically. What works is income tied to throughput, output, or ownership of a small economic process. This does not mean speculation. It means participating in parts of the economy where value is exchanged directly and repeatedly. Mark noticed a co-worker named Daniel who managed a small equipment maintenance operation on weekends. Not a startup. Not a trend. Just a local service with repeat customers. Pricing adjusted annually. Costs were predictable. Demand was steady because equipment still breaks regardless of economic cycles. Daniel was not chasing growth. He was controlling cash flow behavior. That control reduced stress more than any raise. In 2026, the U.S. economy rewards boring systems that sit between necessity and inconvenience. Services that people delay but never eliminate. Logistics support. Compliance preparation. Equipment upkeep. Data cleanup. Facility efficiency audits. These are not glamorous, but they convert time into predictable money without dependence on platforms or algorithms. The second thing that works now is separating lifestyle inflation from income inflation structurally, not emotionally. Mark had tried budgeting apps. They worked until life changed. A move, a medical expense, a family obligation. Each time, discipline was required again. In 2026, discipline alone is fragile. What works is structuring expenses so that increases require deliberate action, not passive drift. Mark changed one habit. He stopped allowing expenses to auto-scale with income. Raises went into a separate operating account used only for income-producing assets or cash reserves. His lifestyle ran on a capped monthly flow that adjusted once per year, intentionally. This created a psychological shift. Spending stopped feeling like reward and started feeling like design. The result was not deprivation, it was clarity. The third thing that works in 2026 is owning productive assets that generate cash without depending on price appreciation. Many Americans still confuse ownership with growth. In the current economy, appreciation is unpredictable. What works is ownership that produces usable cash within months, not decades. Mark avoided anything that required leverage, interest dependency, or long-duration assumptions. Instead, he focused on small-scale productive ownership. Equipment rentals in his region. Storage units partnered with an operator. Revenue sharing in local service businesses where cash was distributed monthly. These arrangements did not rely on resale value. They relied on usage. Usage is more stable than price. In 2026, assets that sit idle waiting for market sentiment underperform assets that earn through activity. This is especially true in the U.S. where consumer behavior remains strong but selective. The fourth thing that works now is time leverage instead of money leverage. For years, Americans were taught to borrow to accelerate progress. By 2026, that model exposes fragility. What works instead is designing systems that free hours without increasing expenses. Mark reduced his work hours slightly by automating low-value tasks at his job and negotiating output-based evaluation. That freed 6 hours per week. Those hours were redirected into his small ownership activities. Time became capital. Not hustle time. Focused, predictable time. This reduced dependency on any single income source. The fifth thing that works in 2026 is geographic micro-optimization. Remote work stabilized, but cost differences across regions remained wide. Mark did not relocate dramatically. He adjusted tactically. Storage in lower cost zones. Services sold into higher income zip codes. Expenses anchored locally. Revenue pulled from broader markets. This geographic spread increased margins without increasing effort. It is one of the most overlooked advantages Americans still have. The sixth thing that works now is maintaining liquidity intentionally. Cash is no longer dead weight. In 2026, liquidity equals opportunity. Businesses discount for fast payers. Partnerships prefer stable contributors. Stress reduces when options exist. Mark stopped optimizing every dollar for return and started optimizing for flexibility. This allowed him to act when small, low-risk opportunities appeared. The final shift that changed everything for Mark was redefining freedom itself. Freedom in 2026 is not quitting work. It is removing urgency. It is the ability to say no without fear. It is resilience against minor shocks. By the end of the year, Mark did not feel rich. He felt stable, calm, optional, and that is what actually works now. By early 2026, Mark noticed something that would have sounded strange just a few years earlier. His financial progress felt slower on paper, but stronger in reality. Net worth charts moved gradually. Cash flow confidence moved quickly. This distinction matters now more than ever. The U.S. economy no longer rewards speed without stability. It rewards systems that survive friction. One of the most practical shifts Mark made was redefining emergency planning. In the past, emergency funds were static numbers, 3 months, 6 months. In 2026, emergencies are not just job loss. They are contract delays, vendor issues, family obligations, market interruptions. What works now is dynamic reserves tied to lifestyle run rate and income variability. Mark calculated his monthly survival cost, not his comfort cost. That number became the foundation. Instead of holding idle funds indefinitely, he layered access, immediate cash, short-term accessible reserves, productive capital that could be liquidated within weeks if necessary. This layered approach reduced anxiety because it matched real-world scenarios. Rarely does everything fail at once. Liquidity staged across timeframes provides stability without sacrificing progress. Another thing that actually works in 2026 is minimizing exposure to systems you do not control. Mark looked closely at where his money passed through. Platforms, providers, gatekeepers. Any place where rules could change unilaterally created hidden risk. This did not mean avoiding modern infrastructure. It meant avoiding dependency. He favored arrangements with direct contracts, transparent pricing, and clear exit terms. Local service agreements. Revenue splits with defined reporting. Equipment leases with fixed usage metrics. These structures reduce surprises. In 2026, complexity is not sophistication. Simplicity is. Mark also adjusted how he thought about growth. For years, growth meant expansion. More clients, more assets, more commitments. In the current U.S. economy, unchecked expansion increases fragility. What works now is depth before breadth. Mark focused on increasing yield from existing systems before adding new ones. Improving margins. Reducing waste. Renegotiating terms. Small optimizations compounded quietly. This approach also preserved energy. Burnout is an unspoken financial risk. In 2026, mental bandwidth is as valuable as capital. Another shift that proved effective was separating personal identity from income source. Mark stopped introducing himself by his job title. That may sound irrelevant, but psychologically it mattered. When identity detaches from a single role, decision-making improves. Fear decreases. Negotiations strengthen. This mindset allowed Mark to evaluate opportunities objectively. If something did not improve control, resilience, or optionality, he passed, even if it paid well. This is a critical distinction in the current economy. High income without control increases stress. Moderate income with flexibility builds freedom. Mark also noticed a pattern among financially stable peers. None relied on a single inflow. Not because they chased diversification, but because life naturally introduces variability. What works now is intentional income layering with clear purpose. One primary income, one stabilizing cash flow, one optional upside component. each serves a role. Mark's primary role remained his job. The stabilizer was his service-based ownership interest. The optional upside came from small, non-leveraged investments tied to real usage. Each layer was understandable, trackable, replaceable if needed. Another important factor in 2026 is how Americans consume information. Mark reduced exposure to noise. He stopped reacting to headlines and commentary cycles. Instead, he focused on data that affected his specific situation. Local demand, contract renewal rates, expense trends, cash conversion timing. This shift protected him from emotional decisions. In the current environment, emotional financial reactions cause more harm than poor planning. Mark also changed how he evaluated risk. In the past, risk was associated with loss. In 2026, risk is also stagnation. Doing nothing carries cost, but action without structure carries more. What works now is asymmetric decision-making, low downside, moderate upside, reversible steps. Mark avoided irreversible commitments, long lockups, personal guarantees, open-ended obligations. This allowed steady progress without sleepless nights. One of the most underestimated advantages in the U.S. economy today is skill-anchored leverage. Mark invested time into operational skills that reduced reliance on others. Contract review, basic accounting interpretation, negotiation frameworks, vendor management. These skills did not generate income directly, but they protected income constantly. In 2026, protection is progress. Another thing that works is aligning financial goals with life constraints. Mark stopped chasing abstract freedom timelines. Instead, he defined what improvement meant for the next 12 months. Less stress, more predictability. One replaceable income stream, one negotiable expense category. This clarity simplified decisions. It prevented distraction. As the year progressed, Mark noticed a subtle but powerful shift. He stopped thinking about money daily. That is the real signal of progress. Freedom in 2026 is quiet. It does not announce itself through dramatic exits or viral stories. It appears as fewer urgent decisions, more patience, more choice. Mark still worked. He still planned. But urgency disappeared. That is what actually works in the U.S. economy now. Not chasing growth, designing stability. Not maximizing returns, maximizing control. Not reacting faster, structuring smarter. By December 2026, Mark did not feel finished. He felt positioned. And that is the blueprint that works now.